welcome to Nender, and today my team and I are going to present about the derivative market and application, the group assignment, and where we will be doing a bunch of questions and we will present about it to you. And my name is Daniel Alim bin Muhammad Halim. Today my group member and I from team 2 from the class of JBA 2724C are going to present about it further. Alright, up next, for the next slide is the team members of our group. First of all, my name is Dina Alami Muhammad Halim. Second, we have Aish Razin. And third, we have Aina Nadira. And the fourth one is Nur Sahira. So this is the group member for our team. And we are from group 2. We will present about it further. Alright, up next is the content of our presentation slide. First, we have introduction. Second, we have hedging technique. Third, we have arbitraging technique. The fourth one, we have speculating technique. The fifth one is the intermonth spreading. And the last one is intermarket spreading technique. Me and my team member will further discuss about this question and discuss about the answers that we have done. So without further ado, let's get into it. And for the next presentation, I will pass it to my team members. Thank you.
Hi, my name is Aina Nadira, and for the introduction, our main objective of this presentation video is to explain our calculation about explore derivative strategies and future dynamic. So we use 4 strategies. First is hedging, second is arbitraging, third is speculating, and last is spreading. So we are selected for contract on Bursa Malaysia. First is FCPO, second is FKLI, third is FKB3, and the last is FMGS. So we are going to hedging explanation first. For the question number 1, let's begin with Ahmed hedging strategy. Ahmed need to secure 2,500 tons of CPO in May and another 3,000 CPO in June to meet the production demand. So he is worried about the rising in CPO price before the actual price. To protect against this, he decided to use hedging strategy with CPO future contract. So for the objective is simple. Look in the CPO price now to avoid paying more later. So for the first step, we need to calculate the number of contracts. So how to calculate? How many contracts does Ahmad need? Okay, for the each future contract for CPO, represent 25 metric tons. So for May, he needs 2,500 tons. That's 2,500 divided by 25 metric tons, which give us 100 contract. And for the June, he needs 3,000 tons. And 3,000 tons divided by the 25 equals to 120 contracts. Okay, so to hedge both month, Ahmed buy 100 May contract and 120 June contract in advance. For the second step is market price movement. Now let's look at what happened in the market. At time T0, when Ahmed entered the future market, he buys the May contract at RM 3,256 ringgit and the June contract of RM 3,245 ringgit. So then later at time T1, price go up. He end up buying physical CPO at RM 3,257 in May and RM 3,254 in June. So at the same time, he got his future position at higher price to RM 3,259 for May and RM 3,255 for June. So for the third step, we calculate for the cash market position. So let's calculate what he pays in the actual market. For May, 2,500 tons times with RM 3,257, and the answer is 8,142,500. So and for the June, 3,000 tons times with RM 3,254 ringgit equal with 9,762,000. So that is the total he paid if Ahmed did not hedge. Step 4, convert per tonnes price. Now, to understand it better, we convert those total into price per tonnes. So for me, 8,142,500 divide with 2,500 equals to RM 3,257 per tonnes. So for the June is 9,762,000 divide with 3,000 of tonnes equals to RM 3,254 per tonnes. So that's his spot market cost per unit before considering future gains. Step number 5 is future market position. Next, let's see how much he gained from the future contract. For me, his price increased from 3,258 to 3,259. That's gain. So it gains of RM3 per tonnes. So 3 times with the 100 times with the 25 tonnes is 7,500 of profit in RM. For June, the price moved from RM 3,245 to 3,255. So that is RM 10 ringgit per tonnes. 10 times with 120 contract times with 25 tonnes is equal to 30,000 of profit. So for the next step is net effect. Now we subtract those future profit from the cash cost. For me, 8,142,500 minus with 7,500 is equal to 8,135,000. So for the June, 9,762,000 minus with 30,000 equals to 9,732,000. This gives us the actual cost after hedging. Next is for the step 7, effective price. And finally, let's get the cost per tonnes after hedging. For me, 8,135,000 divide with 2,500 tonnes and we get the answer 3,255 ringgit. For the June, 9,732,000 divided with 3,000 equals to RM 3,244. So with hedging, Ahmed saved some money. Instead of RM 3,257 in May, he paid 3,254. And instead of 3,254 in June, he paid 3,244. That's the power of hedging. It's protect against price increase. So for the conclusion, by using CPO future contract, Ahmed looked in his cost and avoid price uncertainty. This way, he can plan better and protect his company from unexpected expenses. That's how hedging works in real business situation. And that's all from me, and thank you.
Hi and Assalamualaikum. My name is Nusahira binti Faridan. I'll be explaining about the next question chosen, which is arbitraging. And the second strategy used in FKLI contracts from FIN 549 January 2024. The situation given here stated that we, as a fund manager, has a difficult year to make a stock selection because of the market condition. Plus, arbitrage is a new thing to the company. As we know, arbitrage opportunity exists when there's a difference between the calculated price and the actual price. All the information and the price are already given in the table. To solve the question, first step is we have to calculate the theoretical future price. Fair value equals to FBM KLCI price 1447 plus in bracket 1447 again times with the cost of fund, which is risk-free rate in the table 0.045 minus dividend yield 0.0175 and times 90 days over 365. So the answer is 1457. After that, compare the fair value that has been calculated with the actual price. As we can see here, 1457 just now is smaller than 1462. With that, the CAL CI future contract is considered overpriced because of the actual price is above the fair value. So, we need to sell futures 1462 in BMDB at higher price, and at the same time, buy the futures at lower price in cash market. Step 3. Calculate the number of contract. 6 million times 100% times 1 divided by 1462 times 50 ringgit equals to 82 contracts. Continue with the establishment of cash and carry arbitrage table as a step number 4. In T0 cash market, the company will borrow 6 million worth of physical shares at 1447 and hold until repayment period. However, in T0 future price market, it will be opposite with the cash market. So let's say if we buy now, then we will sell in the futures. If we sell now, then buy later. So go for short position by selling 82 contracts of 90-day FKLI futures at 1462. In T1 cash market, sell back 6 million physical shares at 1476, 2% higher, converge with T1 futures market for long position. Last step, calculate for determination of arbitrage profit. Futures market position equal to selling price 1462 in T0 minus buying price 1476 in T1 times number of contract 82 times contract size 50 ringgit. The answer is negative 57,400. For cash market position, ending price 1476 minus beginning price 1447 divided by 1447 times portfolio value, which is 6 million, equals to 120,248 ringgit 79 cent. For interest expense and dividend revenue, the formula is quite same. Here we will get negative 66,575 ringgit 34 cents for interest expense, which is the cost of the contracts that the company must pay, and automatically a positive dividend revenue. Overall, the gross profit for the company after taking into account all the expenses is 22,163 ringgit 86 cents. Shows that it is still profitable even though facing a huge losses in futures market position.
My name is Ashrazin and we will discuss about speculating question for FMG5. So for the first point is, the question stated that there is a decrease of 25 basis point in OPR, which means there is decrease of 25 basis point in interest rate, which is from 3.75% to 3.5%. So first of all, when we talk about the decrease in interest rate, we will also expect that the price will go up in the future. This is because when the interest rate is lower, there are so many people want to take loan. So banks need to increase the price because the demand is too many. So the supply is low. Then bank needs to increase the price. So first of all, for the first step, we must calculate the initial margin and maintenance margin. But before that, we must determine what is the number of contract. So we get the number of contract of 25 contracts, and we also have the spot price. So we just calculate the initial margin and maintenance margin. But before that, for initial margin and maintenance margin, the question stated that the initial margin is as same level of the maintenance margin, which is RM700 ringgit per contract. So whenever the initial margin goes down or decrease below this level, 700 ringgit per contract, we need to add the margin because the initial margin is same as maintenance margin. So when we calculate, the initial margin and maintenance margin, we get 17,500 ringgit. And then for the next step, we construct the speculating table. For day 0, as usual, which is a buy position, we have a profit and no loss because we haven't done anything for day 1, for day 0. So the current margin is 17,500 ringgit. The next day, which is day 1, we notice that there are some losses Razif faced, which is 3,750 ringgit. So when we calculate the current margin, the current margin is lower than the initial margin, which is 13,750 ringgit. So we must add additional 3,750 ringgit to maintain the margin on 17,500 ringgit. And for the next day, the current margin is still above the initial margin, and everything goes well until day 5. So for the last day, which is day 5, the current margin is 28,750 ringgit. So we must calculate the profit that Razif get when he closed the position on day 5. First, we calculate it using price, and second, we calculate it using margin. So when we calculate using price, we must calculate using the price for selling, which is day last, minus price for buying, which is day 0. So selling minus buying times 100 points times 25 contracts times 10 ringgit, and we get the 7,500 ringgit. So for the margin, we do the same, but we use the margin. So the last day margin minus by the first day margin, and also minus by the additional fund that we use to maintain the current margin, which is 3,750 ringgit. So the final answer we get same as when you calculate using price, which is 7,500 ringgit. So what we can conclude here, Razif gets his 17,500 ringgit, but also he must face some loss, which is RM 3,750 ringgit during day 1 because of his maintenance margin requirement, which is same level of initial margin, 17,500 ringgit. So for overall, the net takeaway profit that Razif get is RM 7,500 ringgit. Then we go to the next section, which is leverage effect. So when we want to calculate leverage effect, we want to calculate the percentage changes in price, and we compare with percentage changes in return. So how to calculate it? Calculate percentage changes in price by using price on day 1 minus price on day 5, and we divide it by price in day 5, then we times 100%. So we get the percentage of negative 0.2636%. Section, we calculate the percentage changes in return. We use the margin from day last, which is day 5, and minus margin for day 0. Then we also minus it by the additional margin that we maintain, which is 3,750 ringgit. Then we divide it by the current margin on day 0. Then we times by 100. So we will get the answer of 42.86%. So the conclusion that we can do here is, we know that percentage changes in return that we get is higher than the percentage changes in price, which means it's good because it indicates that we'll get the profit and we don't really have a huge loss when we use the speculating. So overall, Azif have achieved his speculating objective and get his profit.
Hi, Assalamualaikum Tender. It is me again, Dina Alim bin Halim, and today I wanted to present about the intermonth spreading technique. So let's look into the question. The question 2, this one I have pointed out the info. The first, today is January 2024, and the March FKB3 futures is at 97.2. This is the price for the March, and then for the July, the FKB3 is at 97.44. This indicate a bullish market because the price is going up. So and then at the later date, the price is unexpectedly going down. So this is the narrow spread. So what is the strategy? The strategy is to buy low at 97.02 and sell high at 97.44. This is the bullish market and the narrow spread. This is the technique. Alright, the first step that I have done is first step one is to identify the price of the FKBG contract. So we have T0, far month and near month, and we have T1, far month and near month. I have identified the price, and then the second we have the metrics. So what is the metrics? T0 at January 2024, and under near futures month. So what we have to do is we have to long 5 FKBG futures contract at 97.02. This is because this we have to sell high and then we buy low. So since it is a spreading technique, we have to take in opposite position in the far futures. So we have to short 5 FKBG July at 97.44. However, on the T1, this is the maturity at March 2024. The price has unexpectedly going down, so we have to close the contract with opposite position from T0. So what we're going to do near March, we have to short 5 March FKBG at 96.42. Okay, and then the next far futures we have to long 5 FKBG of July at the lower price. Alright, up next is the step 3, calculate the gross profit or loss in the futures market. So for the March 2024 FKB3, we have to sell minus buy times contract times 25 of contract size and 100 basis point. So what we have here is for the March, we have 96.42 minus 97.02 times 5, that is the contract, and then 25, this is the contract size, and then times 100, this is the basis point. So what we have is we have a loss at 7,500 ringgit Malaysia. However, on July 2024, we have to also with the same formula, we have to minus it by selling minus buy times contract size times 25 and times 100 basis point. So we have 97.44 minus by 96.99 times 5, that is the contract, the number of contract, and then we have to times by 25 times 100 basis point. So what we have is a profit of 5,624 ringgit. So what is the gross loss of this situation? So we have to divide it by gross profit divide by gross loss. So what we have is the gross loss of 1,875 ringgit. Why we have a gross loss? This one is because the price is unexpectedly going down. However, the gross loss is can be minimized because we took a spreading technique. So we have a profit of 5,000 to reduce our gross loss. So the next is the step 4. This one is the net loss. Since there are commission fee, we have to total it and we have to calculate it. This one is a cost, so it will contribute more of our loss. So 100 ringgit times 5 contract times 2. This one is the 2 round trip because we have 2 months here. So the total of our commission fee, we will get 1,000 ringgit. 1,000 ringgit plus by our gross loss. This one both of it are cost, so it will increase our net loss at 2,875 ringgit. This is our net loss for this FKB3 intermonth spreading. This is the answer. Thank you very much. Hi, Assalamualaikum Tunenda, and today I will also present about the last question. This one is the inter-market spreading technique. This is the for FKLI contract. So up next we have to let's look further into the question. This one is question 3, and we have a set of price already there to be taken out. So the step 1 is what I am going to do is I have to find the index value of each market. That is for Malaysian futures market and the United States futures market. So first we have to calculate the KLCI index value. So what we have to do is we have to take KLCI futures index times 50. This one is the standard contract size. And then we have to take the price at 1,441 ringgit times 50 ringgit. What we will get, the index value would be RM 72,050 ringgit. It is the index value for KLCI. Up next, we have to calculate the United States index value, S&P 500 index value. That is, the price is 2,373 ringgit times 250. This is the times for S&P that we took, and then we have to times by exchange rate of ringgit Malaysia at 4 ringgit 74 cent. This is for 1 USD. What we'll get, the index value would be RM 2,812,000 and 005 ringgit Malaysia. That is the index value. And then second, we have to, for the step 2, we have to find the number of contract. Okay, what we will do, S&P 5,000 index value divide by KLCI index value. What we will get is 39 March FKLI futures contract. It is the number of contract for Malaysian futures market. Alright, up next is we have the matrix for the step 3 for the intermarket. Let's look into the matrix actually. T0 December 2023 at United States futures market. Let's open the position with this is the info that I have get. The market is uptrend in the US. And then the US is better than Malaysia. So what we have to do is that we have to long in the US futures market because the market is currently in the uptrend. However, it is in the uptrend for worldwide. However, the US market is better than Malaysia. So what we have to do, we have to long in here. So our decision, long 1 March S&P 500 index futures contract at 2,373 ringgit. So in the still in T0, however in the Malaysia's futures market, we have to take the opposite position. So since it is a spreading technique, we have to take an opposite position. So what we have to do, short 39 March FKLI futures contract at 1,441 ringgit. The 39 contract is calculated earlier. Alright, so at the T0, this one is the maturity period, and then we have to close. Let's first close the United States futures market, take the opposite position from the opening. So we have to short 1 March S&P 500 index at 2,580 ringgit. In the Malaysian futures market, we have to short also. We take the opposite position. We long the 39 March FKLI futures contract earlier at 1,550 ringgit. Alright, the step 4 is to calculate the profit and loss of each market. So for the S&P futures, let's calculate the loss or profit in the each market. So first I started with S&P 500 index futures market, selling minus buying times NOC times contract value times exchange rate. So for the selling price, 2,580 ringgit minus by 2,373 ringgit times 1 contract times 250. This is the contract value, and the exchange rate is at 4 ringgit and 74 cent. What is the profit? The profit is the profit is RM 245,295 ringgit in profit. However, what is the profit for Malaysian future market? We have SMB, still the same formula, selling minus buying times NOC times contract size without the exchange rate. Okay, so the selling price is 1,441 ringgit minus by 1,550 ringgit times 39 of contract number of contract times 50 ringgit contract size. What we have is a loss actually at RM 212,550 ringgit in loss. This is our profit or loss in the each market. Alright, up next is the step 5 and step 6 for the intermarket spreading technique. What we have is gross profit. What we wanted to do is to calculate the gross profit, what we will get from spreading technique of this each market, that is US and Malaysia. So S&P 500 profit minus by FKLI index loss. So what we will get. So let's see, RM 245,000 and 295 ringgit minus by RM 212,000 and 550 ringgit. So what we will get is a gross loss of gross profit of RM 32 ringgit 745 ringgit. This is our gross loss, gross profit, because the US market is more profitable than Malaysian market. Our profit is small. However, in case if there are a loss, our loss will be smaller too. Since it is a spraying technique, we have to take the opposite position between each other. So the step 6 is to calculate the net profit. Since there is no commission fee, no fees whatsoever, the gross profit is the same as net profit. At RM 32,000 ringgit 745 ringgit. That is the answer for our intermarket spraying technique. Thank you very much for listening, and thank you very much to Nende for listening. Thank you very much.